This is Professor Hazer again, and this is the continuation of, let me get this off here. No idea what that's doing. Okay, this is the continuation of the short form valuation series of videos. Okay, and so in the first video, we had used Yahoo Finance to come up with a price of Microsoft on June 30th, 2020, of $202.49. There's a bit of mismatch here, but we'll deal with it. And we had gotten from the analyst estimates a 5-year growth rate of 16.7%. We just guessed super growth cost of capital at 8%. And these are typical parameters. A growth rate of 1% in the constant growth rate cost of capital, and a cost of capital in the constant growth period of 3%. So we have one period of 5 years. We have one period of 5 years where it's going to grow at close to 17%. That's from the market. And then we have another period where assuming it's going to mature and grow about it at the same rate as the economy of 1%. So, and keep in mind that this period here, super growth period, like I say up here, is 5 years, and the constant growth period goes on forever. Okay, so step two. Step two is to calculate the free cash flow. And here's the definition of free cash flow. Basically, free cash flow is free cash flow. This is the cash flow that the firm has left over after reinvesting for its growth needs to pay interest and dividends. So basically, a firm earns a certain amount of cash from operations. It reinvests a certain amount of that cash, and the leftover is there to pay dividends and interest. Okay, and so this is free cash flow to the firm, which means all of its assets, not free cash flow to equity, which is a lower level. That's only to pay dividends. But we're computing the cash flows for all of the firm. Okay, and I want to emphasize this. There's many ways to do this, and this is a very rough calculation. But I like the definition I'm about to give you because it emphasizes the idea that a firm is covering its growth needs. Ultimately, growth is where firm value comes from. So let's see where this is the calculation here. Okay, and what I'm going to do is all these numbers are going to come from the financial statements. This one here is going to come from the income statement. The tax rate is going to come from your ratios that we've already calculated, which is from the previous sheet, like standard ratios, yeah. Then all these three are going to come from the statement of cash flows. That's why I think the statement of cash flows is so important, because this calculation we do here is, in essence, a mini statement of cash flows. Okay, so let's start with operating income. Let's get operating income. It has to be before interest expense. Just keep that in mind. So operating income would be right here would be your operating income. There it is right there. And it is before interest expense because we already know from looking at that the interest expense is in the other income net of taxes. So that is before interest expense. So that number is 52,959. Now let's take it times 1 minus the tax rate, which will give you your after-tax income from operations. So what we're going to do is just go over here to the ratios. And for 2020, we had calculated ratios of, I got to redo that, it's equal to 1 minus, and then the tax rate was, what, 17% or something? The tax rate you calculated here was 16.5%. So you have about, let's see, do this. Your after-tax cash flow is based on 84% rate. Okay, so if we take our operating income, which is before taxes, and multiply times 1 minus the tax rate, that'll give you your after-tax operating income. Okay, now in essence, these next three numbers come from the statement of cash flows. Now, the operating income is converted from an accrual basis to cash basis, just like you do on the statement of cash flows, by taking the changes in current assets to current liabilities and making those adjustments like you do on a statement of cash flows. And notice what I say here is that use the sum of the numbers. Don't go in the opposite direction for assets, same direction as the liabilities, because it's already been done for you. These adjustments, the directional adjustments, have already been made on the statement of cash flows. So we're just going to take the sum, and let's see where we go. We're going to go to the statement of cash flows. Let's see what lines we look at. Statement of cash flows from Microsoft. Obviously, the adjustments for current assets and liabilities in the operations section. So we'll start with accounts receivable, go down all the way to where it says other current assets, and we'll leave off where it says other long-term assets. We'll leave that out. We don't know what it is. So we'll just take the sum of those numbers there, and we get a number of, let's make sure we're getting the right number there, is equal to the sum of, go over here to the statement of cash flows again. Again, I'm doing it because I'm getting a slightly different number than I got last time. Sorry. Here it is, the cash flow statement, sorry. And we're going to start with accounts receivable and go all the way down to other current liabilities. Okay, so that gives us negative 2831, which looks like the right number. Okay, and to that, what we're going to do, so what we've done is, this is your income from operations. We convert that to a cash basis by making those adjustments. And now we want to add back depreciation expense because it's a non-cash expense. But we also want to take out capital expenditures because remember the definition of free cash flow is that is the cash flow left to pay interest and dividends after you have reinvested in capital expenditures, which is your growth. Okay, so let's just go to the statement of cash flows and just take out the depreciation expense. Or we'll add back the depreciation expense. There it is right there. That's in the investing section. So, and we will subtract out our capital expenditures. Now let's look at what the possible candidates are here. Our capital expenditures are going to come from the investing section. And for some reason or other, Microsoft puts its investing section last. But usually it's addition to property, plant, and equipment. You could also, I'm just going to put that in there for simplicity's sake. But you should also put in there maybe acquisitions of other companies. I would say you should put that in there. I won't this time, but you can grow by buying plant and equipment or acquiring plant and equipment by acquiring another company. So we'll just put this amount in here now, and we should subtract that out. We'll have a subtraction there. And so our free cash flow to the firm is, we took out 15 for capital expenditures, is 38,741. Okay, and so that's the free cash flow for the firm, and that's going to be as of, that was from, calculated at 6/30/2020. We want to update that in real life from the 10Q, but that's okay. We're just starting here. So 38,000. So that's a lot of cash. That's $38 billion free cash flow to pay dividends and interest. Okay, and so let's just go over this. I'll stop the video in a second. But you start with your operating income. You take it after taxes. So that's your operating income available to everyone because it's free interest, available to pay both dividends and interest after taxes. Convert it to cash flow income by just taking the change in working capital. Add back your depreciation expense and take out your capital expenditures, and you end up with free cash flow of 38 billion more or less. So I'll post this video and I'll do step 3 and step 4 in 2 more videos.